You want any introduction or shall we straight away go?
Yeah, no, I will start, sir.
Okay.
Good evening, everyone. I am CA Kuldeep Rathi from Jodhpur, Rajasthan, moderator of this session webinar. Hope you all are doing great. We are delighted to welcome you all in this webinar being organized by CECL Committee of ICAI. It is my pleasure to be a moderator for this webinar on Complete Guide to Fema. In a short while, we will start this webinar. I would like to appraise you about the CECL Committee of ICAI. The committee, in line with one of the Institute objectives, partners in nation building, and with a vision to contribute to economic development of India, aims to undertake such activities to technically equip, broaden the scope of expertise of the members to enable them to derive advantage in the rapidly changing scenario and to enable the members to render various business advisory and support services. The program for this evening is understanding about import and export regulations under Fema from one of our eminent speaker, Mr. Ajit Shah sir. Mr. Ajit Shah, he completed his BCom and LLB. He is a consultant in export-import field over more than for 40 years. He has traveled internationally extensively. He is regularly delivering his lectures with export promotion councils, export-import organizations, colleges, and banks. He has written 18 books on export and import. Now, I would hereby request Mr. Ajit Shah sir to put some light on the topic of the day.
Good evening to all the participants and all professional friends. In the process of educating all of you in the field of Fema, today I have an opportunity to talk to you regarding Fema provisions in the matter of exports and import. I will start with the export. We'll deal with various provisions of exports along with some more inputs which you as a professional require to know the subject matter of the exports, because it is very, very essential for you to know the very subject itself and then relevant provisions of Fema. I'm crystal clear that if my professional friend like you is not absolutely clear on the various terminology, various documents, and to some extent the procedure of exports and imports per se, you will not be able to discharge your professional services to your valued clients. All talk which I am going to do, you will be better able to appreciate it if you correlate with your exporters and importers clients. I am too sure that today, let me start with a Chinese proverb. It says that light and angel needs no introduction. Exactly in the same way, to all of you learned chartered accountant, the most important segments of the finance field hardly needs any introduction about what is exports, what is imports. The terminology of export is in the air. 75 years of our independence, 15 prime ministers and 32 political parties at the center. In spite of all these variation, one thing is very, very clear, that export is top priority of the country. Now, since the government is promoting and wanted to encourage for the obvious various reasons, one of which is very well you all will be aware that by doing an exports, we earn the foreign exchange most needed for countries' economy enough that today
Sir, your voice, I think, is not audible. You are not audible, sir.
yeah,
Yeah.
okay. So so since export is national priority, we all professionals also will work in that direction. And the objective of my today's presentation is that at the end of it, you go with the takeaways, whereby tomorrow when you are attending your office, your clients who are mainly into exports and imports, they feel more happy. You can deliver them additionally mileage, and smile on their client's face will be my reward for my today's attempt. With this introduction, let me toss the coin and start our today's topic. Exports generally refers to two things: goods going out of the country and foreign exchange coming into India. Goods going out of the country, and I include services also in that, although I will refer all the time the goods, but services are also implied in that particular part of it. Goods, when it goes out of the country, there are certain controls, there are certain regulations which are being controlled by two organizations, two agencies. That is, one is a DGFT, Director General Foreign Trade, which falls under Ministry of Commerce and Industries, and DGFT, which is a headquarter at Delhi, Udyog Bhavan, and having a regional offices and sub offices throughout the country to cater export community. Goods which is leaving the country, at the gateway, the agency called Customs or Indian Custom, which is under Ministry of Finance, they monitor the revenue and the time of import, as well as the rules and regulation compliance related to goods as per the Customs Act 1962 and the other relevant acts on this. So friends, you as a profession, you as a successful chartered accountant, if you wish to practice in the field of Fema, and if you choose export and import as one of your branch, then the first thing what you need to do is that the entire my presentation is on tripod. There are three legs there are of the table which you should know. A, DGFT and its role, which I will be just touching upon as and when it is required, but I will not be able to do much time on that because my focus is on Fema relevant to this. Customs, you are reasonably well aware that all the goods which are going out of the country through the ship or through the air, the last point, last door where the goods goes out, that is customs or a port, whatever you may call. And third, what we are going to focus is on foreign exchange or the Fema. Reserve Bank of India, popularly we call RBI, is the regulatory body. Please remember, Fema is not a revenue law. It is basically regulatory law. And in India, all the rules, regulations, provisions, guidelines of Reserve Bank of India is monitored through the networking of the banks. So we call authorized dealer in technical language, and very frequently we use as a AD or AD bank. I also during my presentation will use the word AD or AD bank, and what we understand is that if you are going to be in the business of export and import, please remember RBI, who is a regulatory body, but you are generally not required, not expected to directly contact with the RBI. RBI is a banker's bank. You cannot have an account. You have to have your account with your bank. Your bank, in turn, will be associated with the Reserve Bank. They are reporting, they are answering, they are the one who has given this power. With this little background, let us start and understand how this concept started. To make the things very easy, today, if you want to start exports in India, you really require nothing but your one registration, single registration, that is called Importer Exporter Code Number, popularly IEC. And let me give you a little hint over here. 9 out of 10 people wrongly interpret or wrongly say import export code. No, friends, you are professional, so you should be more than perfect. So do not say import export code. The right terminology is importer exporter code. So I hope at any point of time, you will not make this common mistake, which is more prevalent than the actual one. So this IEC, which is abbreviation often used, is online registration, which you require. And that registration is as simple as buying a newspaper. You can do it online. The government, under the ease of doing business, has made it so simple and so economical. Just 500 rupees is the fees. You can do it sitting at your place. You as a professional can do it for your clients, and it takes as less as 3 hours or 30 minutes, and your registration will be there. Lucky enough you are that now your PAN card number will automatically become your IC number. Earlier, that was a different series which was there, but for the ease of doing a business, government has decided, and rightly so. So what it means? It means when you are sitting on a table to make an application of IC, my dear friend, you are aware what number you will be getting it, because it is the same number of your PAN card. It will become the IC number. But it does not mean that you need not require to apply. This is a procedure. Each one of the person, whoever. Now you as a professional, somebody may be approaching you and saying, if you want to start exports, or as a chartered accountant, when you know your client is a manufacturer, when you know the client is growing, where you see some opportunities in your client who is doing a good manufacturing, you wanted them to suggest. And we always understand that chartered accountant is a financial friend. He looks after the company's growth. And I'm too sure each one of you wanted to be a partner of progress. So one more tip I wanted to give is that out of your clients, out of your files, out of the people to whom you are associated, if you find any of your client who is potential, who is financially strong, who has got a team power, who has got a leadership, who has got a quality of the goods, and you as a chartered accountant feels any one of the client who is potential for growth, you can suggest to go them for export import. This, your suggestion today, which is done casually or out of the love and affection, will definitely pay a good premium to them, because many people are, truly speaking, waiting for someone's suggestions. And those who will be lucky clients of yours will pick up this suggestion and go for it, will definitely benefit it, and you will be the one who is the reason for their growth. So as I mentioned, very simple is they take IC code and they are in. Now, what exactly they require to do? I'm skipping those part which is purely an export import, and will restrict during my presentation only for the Fema related provisions. So let us assume that for our easy understanding that you have a client called ICAI International. Your client, now this is for my statement, but you can keep in at the back of your mind any of your company whom you think will be is equal to ICAI International. ICAI International is having an IC code number. They have a product, let us say garment, gent shirts. And this company, ICAI International, wanted to go for exports. You remember as a chartered accountant, you remember as a profession, you remember as an advisor to them, one simple slogan, and trust me, you will never go wrong in your Fema export-import consultancy part of it. What is that punchline? What is that statement which you should emboss on your mind? And that is simple. Entire Fema of the Forex in export-import, I can summarize only in 2 sentences. The first one, friends, you have to remember it by heart. What the Fema says, what is the central line of Fema? Fema says very, very clearly, every exports must be realized and every import must be paid. Just remember this sentence, and you will observe that throughout our study, throughout my presentation, this is the center point around which I am delivering my lecture. So this sentence is something like a mantra. This sentence is a core. This sentence is a central part of it. Second very important thing you have to remember is documentation. You have to educate your clients. You have to convey to your clients that export, many of the time people do ask me, sir, is it export is a difficult thing? What I answer, you can also borrow that answer from me and use it in your office. I always say that, my dear friend, export is not different. Export is not difficult, but it is a different. It's a technical sale. You have to be strong on documentation. And once you decide that you want to go for it, then what it works out. So let us take an example. ICAI International have received the order from, say, Mr. Smith from USA for a 10,000 shirts, value is 25 lakhs. Goods you have already prepared and you are going to ship the goods out of India. So obviously to the custom department, you have to submit various documents and skipping that part of it and summarizing that you are preparing the documents. One document which I would like to draw your attention, and that is the declaration form. So value declaration form. Please remember, custom department, whenever the goods are going, they will certify that value declared by ICAI International is correct. In other words, the value declared, which in other words will be that much foreign exchange you are going to bring into India, that value is not under invoiced or over invoiced. It is counter. There can be a difference between the two exporters. It can't be rupee to rupee, paisa to paisa equal, but it should be within that particular range. So here I will draw your attention to section 14(1)(4) of the Customs Act 1962. Like any other act, there are various sections and all. I'm not advocating for you to go detailed study of this, but at least remember section 14(1) section, which talks about the valuation. In that valuation, this is the value what you declare at the time of shipment. You also declare this SDF form, which was earlier. Now it is a export declaration form, which you give it and you provide all the details part of this. Customs check the documents. No problem. Your clearing agent will complete all the formalities and goods have gone out of the country. That means, in a very simple language, your export is over. Now what you have to do? Please remember, under the Fema, the first thing it is there, the role of the bank is extremely important in the export and import activities. So what is the first Fema provision is that? First Fema provision is that the moment you export the goods, all the original shipping documents that you have to go and submit to your bank within 21 days. This is the most important thing. Equally, this is a thing where there are many people are having a lapse. So let us understand. So what you need to do as a chartered accountant, your clients, you have to explain to them, it is not your choice. You have to submit the documents to your authorized dealer, your bank, within the time frame of 21 days, strictly you have to follow it up and you have to do the first compliance of this. Let me tell you, many people, if they fail over here, then there will be definitely a problem they are inviting to. Now, submitting the document to the bank within 21 days is a first compliance which the Fema wanted all the exporters to follow. Every rule will have some exception. Yes, to these provisions, there are two exceptions which you need to understand this. The first exception is that if you are an export house, trading house, or in a simple language, I can say recognized exporters. Handbook para, policy para 2.31 provides a definition of who are the recognized exporter. Any exporter who has got $3 million exports done in aggregate period of 3.5 years, then he will be given a sticker, he will be given a label, he will be given a recognition that you are a 1-star export house. And that goes up to 5-star. In simple, if you are a big exporter, if you are established exporter, if you are recognized exporter, if you are a 1-star exporter and above, then as a privilege, the DGFT, Ministry of Commerce, has given you an exception. Okay, my dear friend, we recognize you. We recognize your credential. So you need not require to follow the general stream. You can export, you can send all your documents directly to the buyer or the overseas bank. But still remember, for you also, copy set of document you must submit to the bank within 21 days. So 21 days submission. For others, it is original document. For export house or recognized exporter, it is the copy of it. But 21 days is a calendar which you have to follow. Second exception is those exporters who have received full payment in advance. So if you have received the payment in advance, you have been given that liberty to send the original document directly, and you can submit the copy document again within 21 days to your bank. Now let us understand the logic. Any law, any rules, regulation is better appreciated if you know the logic behind it. Reserve Bank of India is having a responsibility of country's forex. They have to conserve the forex, they have to manage the forex, they have to control the forex. Whenever you are exporting the goods, our country's natural resources are going out of the country. Suppose everybody exports and nobody brings the foreign exchange to the country, then India will become second Nigeria. What happened with Nigeria? People export it, nobody bothered to bring the forex, country becomes poor. So it is mandatory, essential, and it is a must for a country that whatever the goods, whatever the natural resources converted into product are being exported, corresponding foreign exchange should come into the country, so it becomes a balance. Now, Reserve Bank's one of the function is to bring the foreign exchange. So for that, it becomes easy. And that is why it has become mandatory that all the export documents are to be routed through your bank. So monitoring whenever the payment is not coming, whenever the party default, whenever the foreign exchange is not realized, not repatriated, it becomes easy for the bank, it becomes easy for the RBI to monitor, control, regulate, and take an action appropriately. That is why the banking channel or banking route is specifically prescribed. With this little background, now it's much more clear that if an exporter receives a full payment in advance, there is no fear. There is no purpose required for him to send the document. If you are one of the exporter who is capable enough of bringing the foreign exchange first into the India, so full payment, if it is received in advance, yes, then you are given a freedom. You are given an exception that original document you can send it to overseas on your own. But remember, in all the cases, either original document or copy set of the document, you have to submit to the bank within 21 days. Hope this point is very clear. Now we see the two situations. Your authorized dealer, let us take an example, say Bank of Baroda, Zaveri Bazaar branch. Asha International is having an account with the Bank of Baroda Zaveri Bazaar branch, exported the goods, submitted a document to Bank of Baroda Zaveri Bazaar branch. What Bank of Baroda will do? Bank of Baroda also has been given a guideline. They will take the document, they will put a schedule of that document. What we generally understand is a covering letter. Those documents will be forwarded to Mr. Smith's bank in America. Suppose Citibank America is the banker of Mr. Smith, our buyer, then Bank of Baroda will send this document to Citibank New York, and Citibank New York in turn will hand over the document to Mr. Smith. This is popularly known as a movement of the document through banking channel, and it is expected by all the bank that they follow strictly with this. Now, one more exception. Suppose Asha International wanted that these documents is to be sent by my Bank of Baroda directly to Mr. Smith and not through the Citibank. For whatever the reason, one of the very common reason is to save the charges, bank charges. So please understand, as per the present guideline, Asha International can make a request, and based on the discretion, based on the judgment, based on the case-to-case basis, the Bank of Baroda has got a power. Bank of Baroda has got a discretionary power, and they may send it directly to the overseas party, that is to Smith and Company, instead of sending to Citibank. But majority of the cases, all the documents are generally routed through overseas party, through his bank. Now, second situation. I am the exporter. I have exported the goods and I have forgotten to submit to the bank, or the day I realize that yes, I have to submit, and on that day 21 days are over. Let us say it is a 50 days. I have a client in Bandra. He is a captain of the ship, retired from his ship profession, and he has started the exports. When I met him, at that time he realized he was doing the shipment very regularly, but he has never bothered to submit the documents to the bank. I remember it was Saraswat Bank Bandra branch. So when I met him, I said, he gave me an entire file. He said, sir, we are not submitting documents to the bank. The reason was he was not aware about it. But friends, all of us, we know, ignorance of the law is not an excuse in the law. So what will happen in a reality? You take these documents and go to the bank, and let us say 21 days are over. So please remember, RBI has delegated a power to all the banks that late submission can be regularized by the bank within their delegated power, but subject to discretion. So when you go on a 50th day to the bank and say, sir, I have not submitted the documents. My documents are reh gaye. Obviously, bank will ask the reason for you, and you have a 15-20 common reasons. Staff nahi tha, bhul gaya tha, file mein chala gaya. You know, these are the common 15-20 reasons are there. Isme se ek ya do reasons aap de denge unko. Most of the time it will happen that bank will not accept the document after 21 days, but they will not say no to you. They will say soft yes. वो क्या कहेंगे? साहब ये डॉक्यूमेंट ठीक है, आपके पास में रखिए, जब भी पेमेंट आएगा तब आप उसको लेके आइए. I will regularize. Understand the logic behind it. The bank discretion power, bank want to use it in such a way that bank itself should not come into trouble. How? The day the payment has come, if the payment has come, then bank will accept the document and regularize, because the purpose of routing or involving the bank and bank responsibility is to get the payment. Let us assume the previous case. Bank has received the document from you. After that, with an understanding that the payment will come, and unfortunately, if the payment is not coming, then please remember, the bank who has regularized the delay acceptance of the document and the payment has not come will be answerable to the auditors of the RBI, will answerable to the RBI. So what the bank will do, they will play safe. So if the payment has come, the bank will be happily accepting this with a little oral warning, next time aisa mat karna, abhi leke aana, but they will accept it and they will accommodate you. So you have to be very, very careful that bank problem will come if you have not submitted the document in time, that is 21 days. And if the payment has not come, please remember, you will have a tough time. What it will happen, as and when the subsequently it will come, I will explain to you this part of it. Now, you have exported the documents. Goods have already gone by sea. The goods are received by the overseas party. When the overseas party received the goods, they have taken the delivery of the goods. And when the goods they have examined, they have found that goods are not of the quality. It is not as per the requirement, and or you have supplied the goods, but the date of delivery is later than what date you have agreed. That means date of delivery was late than what it was agreed. In any way, either on a quality basis or on the basis of time frame or any other conditions you are not complied with, remember, this will give a rise to an opportunity to a foreign buyers to ask you for some amount of reduction. So reduction in the value, that will be very, very important aspect of it. So what we understand, two things. Let us say Smith, to whom $25,000 is the billing what you have done for 10,000 shirts. When he says that I wanted the value invoice to be reduced. Now goods have already gone, documents were already submitted, and that amount was for $25,000. Now buyer want reduction in the invoice. So there are two aspects. You as a businessman will see the loss, will see the loss in profit, will see the loss financially, but you want to retain the customer. Many of the time it happens, you admittedly know that yes, what my overseas buyer is asking, the claim in reduction is to some extent it is genuine also. And once you commercially decide that yes, I will reduce, I don't mind reduction in that, and I wanted to reduce this part of it, then the question comes is that are you allowed to do this or not? So answer is yes, the reduction in the invoice is permitted as per the Fema. So you should have a knowledge that if required, if the situation so arises, you are under the Fema provision, you are permitted to reduce the value of your invoice for whatever the reason. They do not go by the reduction as per the reasons. So any reason which you go and tell your banker that, sir, my invoice number so-and-so, $25,000 was there. And in that particular thing, for whatever the jolly good reason, I have to reduce the value. Yes, 25%, up to 25% if you want to reduce the value, no prior RBI approval is essential. So remember, this is very, very important because we all know that all the time weather are not good. Many times it happens, and more particularly when your business is on a multi-countries and multi-products and you are doing a large number of shipments, this situation will happen because everything is not smooth at all the time. So remember this. I hope it should not happen to you, but if at all it happens, if so situation is there, for taking a decision, knowledge about this provision is very, very important, that you can reduce the invoice value after it has been sent to the extent of 25% of the original value without RBI approval. So you can take the benefits of this. One more provision, which is many people are not aware about. This provision of 25%, most of the banks are also aware about it. But there's one more provision that I think you as a chartered accountant, if you know it, you are one up than the other people. What is the second provision in that? It says that if you are an exporter, that means if the Asha International is exporter for minimum for a period of 3 years, that means what we call it an established exporter. What we call is a old exporter. You are not a newcomer. 3 साल आप already exports में हैं. So this 25% reduction also can be further extended to any amount. If you are an exporter exporting for more than 3 years, then that 25% percentage limit also is not applicable, and you can go for further. You can go for a more percentage of it. Of course, it is subject to your track record of should be very good. There should not be an outstanding amount and all for you. And you can also take the benefit of reduction into that. There are 4 conditions what you have to comply with this part of it, but reduction is possible. Please remember, business decision in international market are required to be taken very fast. You should be, and most of the decisions are knowledge-based decision which you require to reach. I hope this situation should not happen to you that you require to give the reduction. But if at all it is required to good, knowledge is what very important for you to do. So let us take further. That a situation, Asha International exported to the overseas party received that part of it, and the goods have already received by him. Whatever is your payment terms, and based on that payment terms, the overseas party has made the payment to you, and you have received the amount, what we call it, realization of your invoice and repatriation of the fund. These are the 2 words generally used in the Fema, now most of the circular together, realization and repatriation. So now what exactly is the situation? Please understand, for many years in India, the time available to the exporter to realize the value of your export goods was 6 months for most of the exporters and 12 months for a certain categories of the exporters. But now, as per the RBI circular number 37, today your exports realization period is, please note, it is 9 months. So for 9 months, you have to realize your export proceeds, what is required for you to do it. So please note that you have to realize the export proceeds within the period of 9 months. So in 9 months time, you will be realizing the export proceeds as per the circular, RBI circular number 37. That 9 months will be considered from date of the exports. Yes, there is one exception in that. If your shipment is to warehouse, then instead of 9 months, it will be the time, which will be the 15 months time, what it will be considered for this part of it. So 9 months is what you have to realize the export proceeds. That is what you need to work it out this for this. Now let us understand that same transaction, if you are lucky enough and if you get your payment within 9 months, that means you have complied with the provisions of this part of it, and this will be the good enough for this. Now, let us see what happens. Everything does not go exactly as per your expectation. So let us see a situation. Your buyer, Asha International, is good in finance, but for whatever the jolly good reason, he is not able to make the payment to you within the prescribed time. So today, it is a 9 months which is getting over. So what to do about it? You are sure that you will get this particular part payment, but it's not coming in time. This happens. So what you need to do is that you should know that there is an enabling provision in Fema that if for whatever the reason, for any reason, if you are not able to get the payment in the prescribed time limit of 9 months as per the RBI circular number 37, then please remember there is another proviso whereby you can go for an extension of time by approaching your authorized dealer. So what you do is that you go to authorized dealer AD and request him, give him a letter that you need more time than beyond that 9 months. Yes, RBI has delegated this power to your bank, and this bank will be giving you an extension for a maximum period at a time will be the 6 months. So 9 months already you had it, 6 months period they will give it, and that is how basically you get an extension. Bank will follow the formalities. They'll take it a declaration from you that within the extended time you will get this particular part of it, and that is how basically you will get, and it will be your responsibility to realize this particular amount from the overseas so that the compliance of your responsibility to bring the foreign exchange will be there. So the moment you realize the payment, the bank will issue a document called eBRC, and this BRC is now issued online. You need not require to physically to go for this. So please remember, order is a starting point of your business. eBRC is a last point of your business. So moment you as an exporter receives eBRC from the bank, that means transaction is complete and you can close your file. So let us see that you have received the eBRC and that is good enough for you. Are you clear up to here? Kuldeep ji, is it going okay?
Yes, sir. Everything is fine.
Perfect.
Yeah.
Now let us see another situation which has happened with me. In Bombay, where I'm staying, I have a client who got an order from Germany. A lady was there. I was exporting shirts, white color shirts with an embroidery on the pocket reading BOSS, boss. There was an embroidery. We regularly export to her. 1,200 shirts was my shipment. I used to ship by air. She used to receive it and she used to send me the money. About 15 to 16 shipments we have done it over a period of about 24 months. Obviously, when you are continuously doing with the buyer, a different chemistry gets developed. Confidence level was at the climax, and we were very happy to do the business with her. What happened with one of the transactions? We exported 1,200 shirts by air. It reached to the German airport. But for whatever the jolly good reason, we are still today also we do not know, but she did not come forward to take the delivery of the goods. She was not available. We tried to contact her. She was not in a mood to talk to us. We do not know the reason till today also. But we have to accept the reality and the fact that buyer does not want the goods. What will I do it? 1,200 shirts is 1,200 dead body for me. They were all at German airport. Please remember, first minute confusion, first minute depression will be there. But then I have to think practically as a businessman, as a professional, as a leader of the business, what to do about it. Immediately, my eyes fall on the Fema. And Fema has got an excellent provision in anticipation of thinking that this commonly happens in the business. Buyer turns out, buyer owner his commitment. So please remember, all professional friends of you, whenever your client comes crying to you with this kind of a problem, you have to provide them a solution. To be successful chartered accountant professional, you have to remember one sentence. Perhaps you can emboss it on your table. Problem may come from anywhere, solution will come from me. If you follow this slogan, I think you will be able to answer this. Fema has already provided a provision of change of the buyer. Yes, so what I did was that the goods were in Germany. I started talking to other people through one of my agent over there कि मेरे पास में ये 1200 शर्ट रेडी है, गुड क्वालिटी है, बायर किसी वजह से ले नहीं रहा, आई एम लुकिंग फॉर ए ऑल्टरनेटिव बायर्स. We started working hard. Luck was in our favor. We got a buyer. Yes, whenever the new buyer will take the goods, he is smart enough to capitalize the situation. So he will not take it at the same price. Plus, there will be always some expenses at the custom because goods are lying over there. So custom का भी कुछ खर्चा हुआ. So this, whenever there is a change of the buyer is there, please remember, even here, 25%, up to 25% reduction if you required for change of the buyer, this also is allowed. There is an enabling provision in Fema that you can change the buyer and up to 25% and time limit of 9 months if you can maintain, no need for you to go to RBI for the approval. So you can do it, decision on this. What I learned from that situation was, there was another German buyer B who was ready, but the moment he has seen the sample on which the logo of the boss, BOSS, was embroidered, he says, no, in Germany, if I will try to sell these shirts, I will have problem about the trademark. And then immediately I realized that Germany is not the right market. And then I moved that market to Doha, Qatar, and we sold it. So one more dimension you have to remember is that you can change the buyer in case of crisis, even to another country also. Although it is not mentioned, but it is interpreted in proper way. And the interpretation says that you can change the buyer, means change the buyer, change the country, change anywhere you like it out. Two things you have to remember: reduction should not be more than 25%. And the amount realization will be considered from the date of your LEO, that is on shipping bill base, till 9 months only. There is no relaxation that you can get a longer period for this part of it. So you get this part of it. So one more learning is that in case of crisis, you can change the buyer. You should not become helpless. It is not essential that you have to bring the goods back. The option is already given to you under the Fema to support you in this kind of a situation. Clear? Let's check one more provision. It may so happen that you are exporting the goods to, say, a buyer in Africa. Let's say Nigeria. There is a company whom you have exported the goods. So what will happen? You expect that the payment also will come from Nigeria. But one fine day, your banker tells you, आपका पैसा आ गया है, but that amount has come from some Mr. Bhatia from Hong Kong. Your amount, which invoice value, let's say, is a $5,000. This $5,000 are received in your bank from some Bhatia in Hong Kong for against this bill, and everything is mentioned in the Swift copy or MT103, in which it very specifically says, again, this invoice, full detail is given in that. Your banker confirm with you and credit to your account. Yes, friend. Prior to 2013, this was very, very common, and more particularly, it was with the African countries. We all know Africa need a lot of goods to be imported. It is an import-dependent way of life in Africa, but they do not have forex. So, as it happens, you ship the goods to Nigeria, you ship the goods to Sudan, you ship the goods to Ghana, but payment thereof will come from some other country, maybe in London, maybe Hong Kong, maybe Singapore. As long as you get the money, as long as you get the forex, as long as that forex comes through the banking channel, people were of the opinion that it's good enough. RBI issued circular number 70 in the year 2013. And for the first time, it was spelled out that this third-party payment need to be regularized. So what was mentioned in that circular? RBI gave clear-cut guideline to all the banks and thereby a message to all the exporters. And it was like this. Circular says to the exporter, yes, friends, third-party payment is allowed, but not a blanket. There are certain conditions which you have to comply with. What are those conditions? First, you as an exporter, overseas buyer to whom you are sending the goods, and the person who is sending the money, finance. We call it a financer. All three parties, there should be a tri-party agreement. We should know what is your relation between these two parties. So there should be a tri-party agreement which should be in the place. Preferably have it before the order is executed and keep it with you. If required, submit it to the bank. So tri-party agreement, our party written document should be there. That's the first thing. Second thing, second condition in RBI circular number 70 was that in the shipping bill, you will be mentioning your name as an exporter with your IC code, your Nigerian buyer details as a buyer or the consignee and the consignee, but Hong Kong parties who is going to make the payment, his name also should be indicated in the shipping bill. That means on the time when the documents are in custom, it should go on record. And third, the payment which is coming from Hong Kong. So there are FATF countries list, those who are the countries, the payment should not come from that country. So it should be from the other countries which are not covered under the Financial Action Task Force, which Hong Kong is not there. So based on that, these were the three conditions with there. Then third party payment is allowed. It went on. New thing, it was people were facing a lot of problem, and obviously there was a hue and cry. A lot of representation has taken place, and in the circular number 100 in the year 2014, the RBI relaxed the circular conditions which was in 70. So what are the relaxation? The relaxation based on the people's difficulty, based on the people's saying representation, first condition of tri-party, that was relaxed, but it was not removed. So RBI has mentioned that individual bank based on case-to-case basis can relax the first condition of having tri-party agreement. Instead of that, it can be a part of the order copy. It should be mentioned in the invoice. So first condition was to some extent little bit diluted but not removed. Second and third condition continued with that. So that is what it is. The real problem with the exporters which they were facing and which they are discussing is that when the shipment is taking place, at that time, they are not knowing who will be the person who will be sending it, the money. So to some extent, this problem continues as it is. And so if your client is exporting to the overseas party where you are thinking that the payment may come from third party, then please discuss with your client so that you can attend it very, very properly for this part of it. So this third party payment is very, very important for you. But what happens if you have exported the goods and for whatever efforts you have done, the payment is not coming? Yes, bad debts. All are not lucky people. It may happen with you that in spite of your best efforts, there is nothing wrong with you. Right quality, right price, right time delivery you have done. But your bad luck is that the buyer does not make the payment. So it is your business loss. You have lost the money. You have sent the goods. But no, these are limited thinking. This is where exactly the difference is a local business and export business is. when you are in exports business, it is not your loss only. It is a country loss also. Foreign exchange is involved into that. You are answerable to the, you can't say, ye to mera paisa gaya, chhod do usko. No. Please remember one fundamental sentence. Whenever you are in exports, you and your buyer are not the only two parties. You and your buyer are not the only two parties. Whether you like it or not, whether you want or not, whether you opt for or not, whether you choose or not, Government of India is a part and parcel of your transaction because it is export, because it is a forex involved. So, Reserve Bank of India, as well as you, nobody wants that the payment does not come. But let us touch the hardcore reality. And the reality is that sometime it happens that the buyer does not make the payment, either in part or in full. And you are the best judge who will think at a point of time that the payment will not come. If the payment will not come, then obviously you wait for a reasonable time. But if a stage comes where your sixth sense will tell you, where your inner will tell you, ye paisa bhi nahi hai, then what to do about it? Yes, you will feel sorry about it, but then you have to be bold enough and face the situation. In Fema, there is already an enabling provision. Please remember, you need to understand the right of provision. So what we call in the local language bad debts, in international, in exports import, it is called write-off. So please remember that you are allowed, you are permitted, there's an enabling provision for a write-off. So how it is? There are three stages in that. Stage number one, that is called self write-off. You exporter is given the proviso, is given the enabling tool, you can write off on your own. But the amount is 5%. ये calculation ध्यान में रखिए. Amount is 5% of your preceding calendar year. So just to explain you, today is 4th of August 22. My previous calendar year is 1st January 2021 till 31st December 2021. Please remember, we are talking about calendar year, calendar year, calendar year. No way mix up in your mind or thinking or working financial year. Let's not go to the reason why it is so, but it is so. So up to 31st December to 21, from 1st January, whatever amount actually you have realized, that becomes your base. 5% of that amount can be available to you for the purpose of your write-off. That is under self write-off. That means you can take a decision on that. If the write-off amount is within that stipulated amount, you can go for a write-off on your own. Yes, there is a procedure, there is a documentation, which you will have to do it out once you have decided. But after that 5%, then you have to go second stage, which says 10% by your bank's delegated power. So it is your bank who has got a power of 10%, again of the same base, you can work it out. Now suppose your total bad debts, your total write-off amount exceed this particular amount, it is more than this amount, then the last option, the last window, last step is RBI approval. So beyond this, if it is so, then you will have to go to Reserve Bank of India and your regional office of RBI will give the approval, then only write-off is permitted. So whenever you are going to do the write-off, you have to follow these financial limits. Only thing, one exception is there. In the self write-off, if the exporter is having a recognized exporter, export house, as I told you, please remember export house has got certain privileges. So this 5% for the export house, it will become 10% instead. So 10 and 10 bank and 5 and 10 under normal situation. So this is what you require to do it. Bank procedure is there, what you will require to do it. Now, please remember, bank will have certain requirement for this, and that requirement we need to understand for this part of it. So what exactly is that? That first requirement is that this amount, what you are going to write off, that amount should be in your books outstanding for at least minimum 1 year. It should be outstanding in your books for more than 1 year, and you should have done, you should have to establish, you have to convince your bank that yes, I have done enough of the efforts, which also include in one of my case from a Surat. There was a company in Surat, gem and jewelry exporters. Substantial amount was lost in Hong Kong. So when we went to the bank wanted that what efforts we have done. My client visited that country to recover the money 3 times during that 2.5 years. So all 3 times whenever he has visited, the passport stamping and the copy of the air tickets we have submitted as an evidence that this is what we have done. Please remember, documents, documents, documents. Proof, proof, proof. Evidence, evidence, evidence are essential key factors for the bank to be convinced. बहुत लोग बोलते हैं सर हमने फोन पे बात किया था, हमारे पास व्हाट्सएप है, हमारे पास चैटिंग है. Please remember, you keep on doing that, but also simultaneously create the record, because ultimately bank has to use the discretion power. Bank should be first convinced that your write-off is required essentially, and you have done the efforts part of it, and for that purpose you require. So the bank, to convince the bank to use their discretion power in your favor, what is very, very important required is documentary evidence, writing, and that is what all the bank will require for you to take out. There are 7 conditions which RBI has prescribed for write-off purpose, which is a guideline. It is a torch under which your transaction will be visualized. What are those 7 conditions? The first condition is that you approach bank for the purpose of write-off in case your overseas buyer is declared as an insolvent, bankrupt. You got a letter from the liquidator. In Andheri, there is a company. We supply to Spain, and one fine day we received a letter from the liquidator from the Spain, in which our name was listed as a creditor for it, and it was a company was declared as a bankruptcy. Please remember, different countries will have different bankruptcy filing procedures. USA, it is considered as a very, very simple. But whatever may be that individual country, but the moment your foreign buyer becomes insolvent, become declared bankrupt, yes, it's a good case for you, and the bank will consider your application for the purpose of write-off for this. Second is, buyer is not traceable. You are trying to reach the buyer is not available to you. You have deputed the person, you have put a complaint, all the emails are coming back, all the communication is coming back, nothing is being received over there, the address is changed. What will you do it? Absolutely helpless situations. If that is so, you have to prove to your bank, and you have to say to the bank that this is a situation, so I need no other option, but what I require is write-off of this. Sometimes it happens that you have exported the goods what you have exported by that country, port, custom authorities, health department, they have found some problem with that, and because of that problem they have decided to destroy the goods. There will be a destruction certificate. If that is the case, then obviously that the buyer will not make the payment because buyer has not received the goods, but the custom department, port authority, health department, they have destroyed the goods. Then this will be a good case for you to apply for the write-off. Generally, this happens with the food, perishable items, and this generally do not happen with the engineering goods or plastic goods. Chemical also it happens. Then if that is the case, then you can definitely go to the and then asking for this. Many people are not aware that our High Commission, our representative, embassies overseas, they also play a very, very important role because they are our representatives. Many of the time it happens that a buyer do not come forward to make the payment and we involve the foreign embassy. We lodge the complaint. They are local people over there. They have a better strength than we have. They have their hands are more longer than our hands. So they intervene it. They do it out and they do it an excellent job, which we must appreciate. What they do, they call the party, they call you. They somehow others come into the playing a role of not an arbitrator, but a settlement kind of an agency. They do it out. Let us take an example. You have to take 10 lakhs of rupees from a buyer in Sri Lanka. And our embassy, our High Commission over there, intervene in that. And out of that 10 lakhs, they somehow other manage 7.5 lakhs. बोलो खत्म करो उसको 7.5 लाख रुपया लेके आप भूल जाओ. Yes, जो remaining 2.5 lakhs, which is unsettled portion, unreceived portion, that is a good case to the bank to write off this part of it. So this is also basically it is to be worked out. Here, one more condition is there in any one of the invoice. If there is a less realization to the extent of 10%, then that also is a good case for write-off. But I still fail to understand that if at any point of time 10% is less, then instead of going to write-off, why not we go another provision that is a reduction of the invoice. However, this provision also is made available to you, which you can do it out for this. The next condition is that suppose the amount what you receive, if you can establish that if I go for a court case, if I file a legal suit against that person, then the cost of the legal court matter case, the amount what I will require to spend, the amount which I'll be spending for a legal case, even if I win, the cost of my litigation will be higher than the amount what it is. If that can be established, then also the bank, it has got a good case that the bank can work it out, the write-off part of it. And one more proviso is that if I am going to have some amount to be received because of the difference of LC and the actual amount. Say LC is for 10 lakhs, but I have exported 10 lakhs and 20,000 because my production was there. So 20,000 I'm putting it extra, and that extra amount is not coming forward. Or there's a difference of freight that also is not coming. If this is a situation, then the bank can also go for the write-off part of this. One thing is very clear. Whenever the write-off is to be taken, when the request is done, bank, before doing the request, the bank will ask two things from exporter. The one is, yes, you are not going to receive this amount. But what happens? When you have exported the goods, we have already given to you the duty drawback in anticipation that full value you will realize. Now you are realizing only less value. So whatever extra amount of duty drawback is given to you, you please surrender that amount. So please remember, you as an exporter has to surrender pro rata, proportionate, any benefits which you have got it, which you have received it from the government. So obviously, and it is a logical, if you do not receive the forex, you do not entitle to the benefits. So benefits, if you have received it, you have to return back to that. You have to give the evidence before you apply for the redemption, write-off part of it. So bank will do it. Second thing, there are basis, you have to calculate what was your export realization in last calendar year. Obviously, bank for this will depend on you only. a certificate from chartered accountant confirming what was the export realization in the previous calendar year and which are the invoices amount all which you require to write off. That details you have to give it over there, and based on that the bank will consider your application based on this, whether it is a self write-off, bank delegated power, or it is to an RBI. Based on that, you will work it out with this part of it. Now, in growth story of your business, there's a one person who always have a lot of contribution to do, and that is called foreign agent. Yes, for many business, agent, overseas agent, marketing agent has an important role to play. Agent does not belong to Mother Teresa's family, so you have to pay him his commission. There is an enabling provision also over there. I remember I'm into the field for last 40 years. So I remember my early days where Fema was there. At that time, commission was allowed only 2.5%. Nobody will work at 2.5% even in those days. RBI realized, and over a period of time, that 2.5% has become 5, 7.5, 10. The last, it was 12.5%, which is very decent, which is good enough for the international standard. So there are two things which you have to remember as an exporter, that what is the agency commission enabling provision in the Fema. Whatever the commission you wanted to give it to the agent, I suggest please have a document called agency agreement. There are many drafts available on the internet. You can pick up any one of them, modify it, or even as a professional chartered accountant, you can draft a suitable agency agreement. But it is always necessary that you should have a agency agreement, which can be short enough. It can be 2 pages also. It need not be a very legal document, but it should be something which is what you and the agent have understood should be written down. Oral mein nahi chalega. So you should have an agency agreement in place. Second, whenever you are exporting the goods, this is very important, which your client should understand. Suppose I am exporting this ball pen and I am putting the value as 100 rupees. So the role of the custom, then the custom has a role to check the value. If I have written 100 rupees, the custom officer will look at the pen and they will confirm, yes, it is 100 rupees. But suppose there is a commission of 10 rupees in that, which if I declare in the shipping bill, that means the value, the amount which is going to come into India, or the value for the purpose of exchange is 90 rupees only. Then the judgment the custom officer will do is that, is it that 90 rupees I should pass as correct value or not? So please remember, commission is essentially to be declared in the shipping bill. If you don't do it out, yes, you are inviting an area where you will have to do a lot of discretionary power of the bank. Second thing, which is very useful for you to understand, is that the RBI, we must appreciate RBI, that how practical they are. RBI has already provided the enabling provision, and that provision, it says that you can either deduct this commission in overseas itself and bring the net amount. 100 रुपए की चीज है, 10 रुपया कमीशन है, मैं वहां से खाली 90 रुपीस लाऊंगा, 10 रुपया मेरा बायर उसको ही दे देगा वहां पर. Good enough. Second option which is there is, मैं पूरा 100 रुपया इधर लाऊंगा और 10 रुपया मैं वहां पे रेमिट करूंगा. Please either reduction at the initial or after bringing it, sending it back. Both the options are available. It is the exporter who has to take a call, whatever is suitable to him and his agent overseas and his buyer. That is how it is allowed. So to that extent you can say, and you must salute RBI, way of working that whatever the exporter comfort is there, this provision is given to you. But the problem is what we have faced in our clients also. Whenever they approach the bank for the remittance, of course, the full payment should have received, then only you can remit out of that. रेमिटेंस जो आप करने को जाते हैं तभी पता चलता है शिपिंग बिल में डिक्लेयर ही नहीं किया है. Yes, then it is a problem because the correct valuation is not done by that. Custom department, custom officer is deprived of that opportunity to do this part of it. So in that particular case, what will happen? If the commission is not declared, the bank has got its discretionary delegated power. They will take the agreement, they will take an undertaking, and based on their discretion, they will be able to do this particular part of it. But bank will not do it repeatedly. Bank may accommodate you. If you are a good client, if there's a genuine, if there's a document support in 1 or 2 transactions, but not often. So today, the biggest challenge with the exporter is that of compliance. So what you need to do is that you have to have the good compliance, and declaring commission in the shipping bill is one of the compliance, one of the conditions which you should do this part of it. We are moving toward the end of this export topic in the prescribed time. Let us see a situation that you are exporting to Hong Kong, let us say finished diamond, what we call cut and polished diamond. The party in Hong Kong is Hong Kong International. In India, it is a AJ International. So Indian AJ International is exporting to Hong Kong International cut and polished diamond. Regular, my shipment keeps on going and the buyer is getting that. Incidentally, it has so happened that AJ International of India is also importing from Hong Kong International rough diamonds. So that is my import, that was my exports. So what happened at a point of time? You all people are masters of accounts, so I hardly need to stress anything that one is a payable, one is a receivable. For years together, in spite of the request, the RBI was of the opinion that both the pipeline of the forex movement, inward and outward, cannot be mixed, cannot be merged at the instance, at the end of, at the gate of individual exporters. So for years together in India, all the amount which AJ International of India has to receive for the exports made to Hong Kong International were received in absolute amount. Total jitna bhi shipment hota pura paisa aa jata tha. Or AJ International was making the payment to Hong Kong International for all the rough diamond what they have purchased, what they have imported it. But RBI has cautiously considered and given an option, what we call netting off or a set off. Today, there are enabling provision. Yes, there are certain conditions that buyer and seller should be the same. Both the transactions should be in the same calendar year. Both the parties should give the confirmation. All these conditions are there. But message to you is that today, it is available. You have to examine in detail that provisions, and if that conditions, if you are in a position to comply with that part of it, yes, you can take the benefit of set off or a netting of what is given to you. So we take the last part of it, and that is what we call, earlier it is a GR waiver, now it is called EDF waiver. Let us understand the first sentence with which I started. I started saying that export means goods going out and foreign exchange is coming into India. But what happens if there are certain situations where goods are going out, but no foreign exchange is going to come? Say, for example, I got a machine which I'm sending out. Sending out is very, very reasonable to exports. But I'm sending that for repair purpose. So the person who is going to do the repair work, I will have to pay that, the goods will come back. Well, friends, when the goods are going out, at that point of time, if there is no export realization, there are several cases like you are supplying a goods for exhibition purpose. Goods are going to you only as an exhibitor over there, a stall number for a particular thing. You will do the display of the goods. Some of the goods you will be selling, some of the goods you will be giving the gift, balance you are going to bring it. So in the customs, when the goods are going out of the country, it is reasonable to exports. So to distinguish, yes, your bank has been given a power that they can issue what is a letter that is called EDF waiver. That waiver says that yes, these goods which are going out of the country, for which no foreign exchange is involved. So that's how basically you need to work it out with this. So with this, friend, I think I will be closing my topic on exports. And with your permission, Mr. Kuldeep Singh, if you say, then we switch it over to the second part, and that is an import.
Yes, sir. We can proceed.
Perfect. Okay, friends. So that is for the exports. Now we will go for the import. We'll go for the import as our remaining time. Now for import, it will be again same way as the goods are coming in and foreign exchange is going out. Please remember the circular FED Master Direction 1717 dated 1st January 2016. That is the circular based on which my total presentation in the remaining time will be there. This circular of RBI deals with import of goods and services. Now, till today, that means 4th of August when I'm talking to you, the circular which was originally, which was dated 1st January 2016, has undergone 11 times. There are 11 amendments. The latest amendment, the last amendment was on 31st May 2022. Yes, law, act, provision should not be stagnant, but it should be stable. So the proviso remains stable, but wherever there is a need, wherever there is a situation, it undergoes changes. Now, what they say in this provision of import of goods and services, let us examine it. There are 3 things which the Reserve Bank has given preamble, given the direction to the bank. In the import, yes, the bank has to follow the normal banking procedures. So import, we have to make the payment overseas. Goods will be coming over here. So let us say Deepika International is an importer in Bangalore. So Deepika International, who is an importer, also will require the IC code number because that's a mandatory requirement of the DGFT. And one distinct feature in the import is that as a part of the payment terms, importer will require to open the letter of credit, LC, as we popularly know. Please remember, there is an organization called International Chamber of Commerce, ICC Paris. They have documented UCP 600, which is a Bible for the LC. It is an international commitment. Our government, RBI, Indian importers should obey this document. So RBI is already clearly given to all the banks that whenever you are opening an LC, whenever you are dealing the letter of credit, please ensure that UCP provisions, Uniform Custom Practice provision as prescribed by the ICC, must be strictly followed, comply with it, so our government, our country's reputation should not be affected. And yes, in import, there are payments. In overseas, whenever the payments are there, yes, we have an income tax law in the taxation, which is your core subject, but not mine. You know that some of the remittances, when it is done overseas, you have to deduct the income tax also, section 195 and all. So 15AB, 15C, that provision also, bank should have the working knowledge of that part of it. So what they are saying, that three things you have to remember. You have to remember UCP 600, that is a document. You have to also comply with the LC part of it, follow the normal banking, and follow the income tax guidelines, which is over there. In import, since the remittance is going this, bank has to be double cautious. So all the banks are required that you should have the KYC norms of all the parties on whose behalf you are remitting this part of it. So what they are saying is that whenever you are using any remittance for any party, you should have done reasonable KYC norms and you should be satisfied, and then only remit the amount part of it. What responsibilities the bank should have it when they handle the import transaction? We know in the DGFT and the customs, the basic thing is that the goods are allowed to be imported, goods are allowed to be exported, are designed and defined by these two EXIM control agencies. What is the present situation in India? Present situation in India is, remember this as a statement, all items are allowed to be imported freely. I repeat, all items are allowed to be imported freely except negative list. So what is a negative list? Negative list is in three parts. First, prohibited items. Ivory, you cannot import. Wild animal, you cannot import. So there's a list of the items which is a prohibited items. Then there is another list which is a restricted items. You can import the restricted item only if you get specific import license, SIL, from the DGFT headquarters or the DGFT regional office. And third is STC, that is the certain agency, what earlier we used to call canalizing agency, like Indian Oil Food Corporation. So there's a list of the item. Those items only are allowed to be imported by those state trading agencies. You and I cannot import it. So what under the Fema provision? Very important. Fema has put responsibilities on the bank. I'll give you a simple example. Let us assume that import of, let us say, copper is ST item. Only MMTC can import. Take the example of gold. Gold is allowed. Kalyan Jewellers wanted gold to be imported, but gold is canalizing item. If Kalyan Jewellers go to the bank to open the LC, yes, bank has to take care that this particular item, if it is not in the outside the negative list, they have to ensure that provisions are already there, comply with this. So the first thing is that the bank should have the reasonable knowledge about which items are allowed to be imported, and when they are dealing either for open the LC or for remittance, they have to ensure that the EXIM restrictions compliance are also done with that. So that is one more part which they require to do it. One very good news for all the people who are into import or who wants to spend the foreign exchange over there. Let us take one example to make you understand very, very clear. Say, for example, I go to the bank and I say that I want to travel abroad. And with the bank, I make the procedure and collect, say, $5,000 for my travel purpose, current account transaction. So I, in my application, have made that I need $5,000 because 2 weeks I'm going to South Africa and I need the money for my travel purpose, for my spending during my stay overseas. Now, suppose out of that 5,000, which I have taken for a purpose of travel. Out of that $1,000, I want to spend for a purpose other than the travel purpose. Say, for example, I want to give their advertisement and I spend that. So the purpose for which I purchased, I drew the Forex for which I have written in the application is travel. But all 5,000 out of that 1,000, I am using for a purpose other than the travel. Then what happened? Am I to go back in the bank and declare it? Am I to make the correction in my application? Is there any reconciliation? The answer is very, very good. The provision which is given in the Fema is very encouraging. It says that any person acquiring foreign exchange for a permitted use is free to use that for any other permitted purpose for it, and no reapplication or no permission use. So it's a blanket. You take it for one particular purpose, but you can use it for any other permitted purpose. I think this is the provision what they have given is something which we must compliment to the RBI for giving us an ease of our life and for which we can work it out for this. So any purpose Forex you can do for this. Mainly this circular number 70 talks about payment under the import. So when the remittance is done, suppose tomorrow you want to import it something from China. So the your supplier from China will say, give me payment. You have made the payment. So your bank has remitted this. Now, please remember that remittance, what you have done for the payment of import, you have, your obligation is to provide the evidence of import. So that is nothing but a bill of entry. There's a time limit within which you have to submit this evidence to the bank as a satisfaction that this is what you have done it. Now, the other way around, that proof of evidence, you have to give it this particular part, and based on that evidence, they will make the necessary entry that yes, this remittance is done and remittance is properly utilized for this part of it. IDPMS. This is something which is today a biggest problem or biggest challenge among the exporters and importers. Let me slightly touch upon this in a little bit more detail with the available time. IDPMS refers to import and EDPMS refers to exports. So whenever I am going to my bank and I do the remittance, that means from my bank, it is recorded that outward remittance, ORM, outward remittance message is created, that against my IC code, this amount will come in the system. The bank will create ORM, and in the software system of EDPMS, IDPMS, that is a software platform of RBI. The data will be captured and it will create a record. The moment I will import the goods, the bill of entry will be generated. And in that bill of entry, which will be EDI enabled, all the custom work is today online. So the moment my import is coming, it will be over there. My banker AD code number I will write in the bill of entry, and then there will be two entries. In that, one entry talks about my remittance overseas, second entry talks about the goods coming into India, and the bank will match these two parts of it, and the entry will be knock off. My overseas payment will be settled and the entry will be no more outstanding. This is very simple, reconciliation kind of things. But what happens? For various reasons, today also, if you go back tomorrow to the office and ask all your clients who are into the field of export and import and tell them, okay, can you take out your EDPMS statement and IDPMS statement and let me know how many entries are outstanding? Friends, you will be surprised that depend upon that turnover, depend upon the number of transactions, depend upon the efficiency of the bank, depend upon the reporting and the compliance your client has done. This outstanding entry in EDPMS and IDPMS, each can be anything from 10 to 100. And that is alarming. Please remember, compliance is today keyword. Business तो आ जाएगा, profit भी आ जाएगा, take home profit भी रहेगा. But if the compliance is not done, you will not have a peace at the time of sleep. So today, as a professional, as a chartered accountant, what essentially you require to do is that you have to convey to your clients, you have to convey to your exporter, importer people that please focus on compliance. EDPMS and IDPMS is basically two elements of the software of the RBI, and I think you can put a focus on that and understand this particular part of this. After the import is being done, documentations are to be submitted to this bank, and bank will take on record and it will work it out with this. The last part of this I would like to discuss, that is very, very specific transaction. We call it a merchanting trade, MTT as it is popularly known as. So what exactly the MTT is? I am in India. I wanted to manufacture bulb from Vietnam, and I want to sell that bulb to Doha, Qatar. So what are the options available? I place the order in the Vietnam to the supplier, take the delivery of the goods in Bombay, in India, bring it to the customs, take it to my factory, and then reship the goods as it is or with the modification sticker, whatever I want to do, and then send it to Doha, Qatar. This is traditional way. This is the old way. This is the way in which the time, cost, and profit all will go. Profit will be evaporated. So this is not the right way of doing. This is the old way of doing. So what is a smart way? What is the present way? What is the real way of doing this? The real way of doing is called merchanting trade transaction, MTT, which is available in Circular 17 in detail. How exactly it does? First, since goods are not coming into India or touching India, DTA area, you will say that this is not an import transaction. Agreed. Goods are not going from India DTA area, so it is not an exports. Yes, the transaction is not exports, so DGFT does not come into picture. Transaction is not import, so custom is not coming into picture. Then where this transaction can be locked, and it's a legal transaction? The answer is Fema. How it works? The goods what you are going to export or import under the MTT in the transaction should be freely exportable or freely importable product. That's very clear. Now what will I do it? I will place a purchase order on Vietnam supplier at, let us say, at a price 100. So Vietnam supplier, based on my order, he will manufacture the goods. When the goods are ready, I will give him an instruction to supply the goods. So he will make all the documents on my name. I will be the purchaser. I will be the buyer. All the documents will come to me through the banking channel, and goods will be kept on the ship, which will be going directly to Doha. Goods will not come to me, only documents will come to me. The moment I receive the document, I will make the payment like import. But to distinguish normal import with the MTT import, the word used is a import leg, export leg. So my bank will make the payment of an import leg, and Vietnam buyer will receive the payment. My import leg is over. Goods have already left from Vietnam, traveling to Doha, Qatar. What will I do it? The documents which I have received, I will make another set of documents, what we call technically is a mirror document for 120, 130 higher amount, and will send it to Doha, Qatar. So my full set of documents, replaced documents, will go over there. Now, I have two options. I can either use the same BL, but in that case, the name and other detail will get disclosed, which most of the people do not like it. So in that case, what the people will do is that they will do what is technically called in the shipping industry, switch BL. So switch BL is nothing but modified BL in a simple language, or wherein certain data are altered to suit the transaction. It's a different issue, whether this is allowed, not allowed, whether shipping line will do. It's a question of the further separate discussion. But switch BL is a common practice. Now, my Doha Qatar buyer will get the goods by the ship and my document from the bank. Doha Qatar will clear the goods and he will make the payment to me for 120. So that is the transaction which is known as MTT transaction, or you can say merchanting trade transaction. Friends, if your clients is having a contacts overseas because of the overseas traveling, we see a huge scope in this one. For many years, in spite of being in the line, in the earlier years, I can say there were hardly any transactions which were MTT. Today, I have seen the trend for MTT transaction is going substantial. Few things you have to remember, that starting of the transaction, there are 4 events you can work it out: shipment of the goods, reaching of the goods, sending the money, and receiving the money. All 4 events, you have to arrange them on a chronological order, on a calendar base. So first transaction you give the alphabet A, and last transaction you give the alphabet B. Please remember, as per MT transaction, alphabet A and the B distance should not be more than 9 months. This is very important compliance part of it. And second compliance is that for any reason, if you require to give advance payment to Vietnam party even before receiving the payment from Doha party, that means outflow of the forex, if it is there, then please remember, as per the RBI guideline, that outward payment, outflow payment should not remain there for any time more than 4 months. That means you must get that amount, replenish that amount from Doha, Qatar within 4 months. There are certain guidelines like third party payment is not allowed, and all those factors are there, which we need to work it out also for this part of it. So this is what basically I have to say for this. Kuldeepji, I think the remaining 15-20 minutes we can give it for the question answers, or for the feedback, or for the comments, whatever the way you require. I think I have finished the basic content part of it.
Okay.
Yes,
So,
sir.
like to welcome the questions, as the session was very great, though I don't think anyone will have any type of doubt, but we welcome for the questions. Yeah. This question from Venkateshan Kupasamy from Mumbai. Sir, the product is under restriction while it is imported in India. The product is EN 590. Lichesen is 2710-2010. There is an MTT transaction. Can the exporter do export of the restricted item? He strictly follows all the other conditions applicable to an MTT as per the AP DIR Circular 115. Can the AD deny carrying out this MTT?
Yes, because one of the condition is that the product which is involved into the MTT transaction necessarily should not be the item which is in the negative list. Yes, sir. Any other question?
Yes. Now from Shramishta Menon from Kochi. In this case, the invoice will be in the name of original buyer. So how do we take care of the documentation? Do we withdraw the original document from the bank and submit new invoice in the name of the new buyer?
Exactly, exactly. Because yours is an import leg, so that document is in your name. So you take the possession of the document, keep that document as your base, make the mirror document because the goods are the same. So document will be there. You will be changing, editing those documents, including value, name of the supplier, name of the buyer, and submit a second set of the documents to your banker. What the banker will see is, which is a guideline given by the RBI, that MTT transaction should not be the only financial arrangement. There should be a genuine profit. So depend upon the product, there should be a profit which should be there, then it will be permitted. So answer is yes, full set of the document you have to take it and replace the documents by the another set in which the buyer will be Doha party, value will be 120, exporter will be your name. So what we call it a mirror document.
Okay. Are the same provisions applicable for export of service also?
Yes.
Okay. Next from Aniket Borkar from Pune. So realization के लिए extension कब करना है? Before original 9 months over or after 9 months over?
See, we say that you at least do it when the 8th month is over. Because what happens if it is not done on the 9th month, and if you do thereafter, then that intervening period, the custom department will demand back from you the drawback.
Okay.
So preferably answer to the question of a Pune chartered accountant is, it should be done before 9th month expiry.
Okay. Now from Venkateshan from Mumbai. In an MNC environment, the payments come from one group company and made to that group company. They do it for services. Is that allowed? I feel that we should get the permission from RBI for netting off. Am I correct in my understanding? Please advise.
So netting off is for the goods. So in netting up, the one of the latest changes which has taken place is group to group it is allowed. So member company of one group and member company of another group in India, if it's a group company concept, then it is permitted now. Earlier it was not there.
Now from Aniket from Pune. Sir, मान लीजिए export किया and अगर payment नहीं आया, but customer is ready to send back the goods, then क्या goods वापस import कर सकते हैं? And in such case, whether imported amount and exported amount can be set off?
Yes, no, it is like that. आपने माल export कर दिया है, पार्टी को नहीं चाहिए, then you can bring the goods back. उसने पेमेंट नहीं दिया तो ठीक है, और पेमेंट पूरा दे दिया है तो there is a provision in the Fema that is called export refund. सो आप पूरा अमाउंट उसको रिफंड करता है. जब पूरा अमाउंट रिफंड करेंगे तो गुड्स को इंडिया में वापस लाना मैंडेटरी है.
Now from Ankush Pava from New Delhi, for write-off, conditions prescribed by RBI are mentioned in Fema or in master directions.
Master direction 16, master direction 16.
Now Venkateshan from Mumbai, sir, what is the exact circular that allows 12.5%?
Circular number you require?
Yeah, might be.
It is, you can write down FED 16/1560 dated 1st January 2016 as amended.
Now, Aniket from Pune, what is the difference between BRC and FIRC?
BRC and FIRC difference you can easily understand if you know the difference between the restaurant and the theater. What is the difference, Aniket, between the restaurant and the theater? Theater, you pay first and then see the movie. Sorry, movie, you first pay and then see the movie. Restaurant, you first eat and then you pay. Exactly the same way. If the amount is received first in advance, then the document which the bank gives is a FIRC. Now, FIRC system have been stopped, but foreign inward remittance certificate. Now, in some of the cases like services, many banks are issuing the EFIRC. Bank realization certificate is after the shipment is over and submitting document. BRC is a document which is a conclusive evidence that the payment is received for so and so shipment. It is a link with the shipping bill. FIRC is a general statement which only confirms that this payment is received, but for which invoice that is not there. So both are the realization. FIRC is a first, earlier, prior. BRC is a subsequent, after the shipment. The objective of both the certificate is your banker confirms the realization of the amount.
Okay. Now from Shagufta Sheikh from Mumbai, in exports, if payment is not received within the time frame of 9 months, we apply for extension. What is the position when payments for import is not made within 6 months?
Same way, you have to apply for the extension, and the RBI and the bank can give the extension totally for a period of maximum period of 3 years. Only thing, the reason what you are giving is very important. Suppose, let's say for instead of 6 months, it is say you want to make the payment after the 6 months, let's say on the 10th month. Bank will only take one undertaking for you, that extended period. Instead of 6 months, you are doing for 10 months. The remittance interest on that they will not allow. So if you give an indication or if you give in writing that delay, because of that no interest we are going to give it, bank will happily give it. If you say no, we also wanted to give the overdue interest for that, then RBI approval is required.
Now from Shramishta from Kochi, are all the provisions relating to export of goods applicable to export of services?
Yes. Only netting off the outstanding or the receipt or payment of goods will not be set off with the services. So cross is not allowed.
Ashish from Mumbai, can we contact you in case of any queries in future?
Sir, you are the right person to answer this.
Yeah, I think it's not possible as a number of professionals watching this video though.
I leave it up to you, sir.
We go to next question. Aniket from Pune, extension of time to collect export proceeds should be applied before 9 months over or
Yes.
can do after?
No, I suggest you do it before 9 months. Otherwise, if you do after 9 months, bank will get one more excuse for not to grant it. Practically speaking, you should do it.
Yeah. Now from Harshita from Mysore, there is a slump sale happening between two Indian subsidiaries, whereas the consideration is being settled globally in US market between their subsidiaries. How can the consideration be settled in the books of Indian subsidiaries?
See, if the transaction is taking place between the two companies in India, it is supposed to be in the INR only, resident to resident.
Aniket from Pune, if goods exported and payment not received, can we bring back goods back to India? I think this question we already done. Can import amount be set off against export amount?
Yes,
We
but
have,
provided both the parties, both the side, the parties should be identically same,
yeah.
not with a distinct people.
From Murlidharan from Kochikode, could you please explain MTT once again, brief?
Sure. Let me briefly recapture this. MTT is permitted for the goods which are not in the negative list. It is not an export since the goods are not going out of India. It is not an import because goods are not touching the DTA area of India. So it is technically what the people call it a third country transaction. You are in India. You are purchasing the goods from Vietnam. The product is a, let us say, bulb. You place an order with a Vietnam supplier at a ₹100. You have an order from Doha, Qatar buyer for ₹120. So goods will be manufactured by the Vietnamese supplier. He will send all the documents to you, which will be for you, it is an import leg, because they want to distinguish with the import and the actual import and import leg. So for MTT, everywhere the word terminology used is import leg, export leg, and you are called as a merchanting trade transaction and merchanting trader. You are not called exporter, you are not called importer. Transaction is not called import transaction. Transaction is not called exporter. All terminologies are different. So the goods which will be shipped from Vietnam to Doha directly by the ship, documents will be receiving first in India by you from the Vietnam. You will make the payment to him. You will make another set of document, what we call it a mirror document or a copy document, send it to Doha for 120. You will receive the money from Doha, 120. You already paid 100, 20 is your margin. Entire activities should be completed within a period of 9 months. For any reason, if you have to pay to Vietnam advance amount, then that advance should not remain out for more than 4 months. The amount from Doha should be received within 4 months. This is an MTT transaction.
Next from RP from Mumbai, in case of long-term advance against exports received by Indian company, in case of failure to export goods, can the Indian company issue shares against balance advance amount? That is conversion of advance to equity share option available with RBI approval?
With the RBI approval, yes. But understand first thing, the overall for Fema, in Fema, for anything you want to do, there's a specific way of doing. So if you wanted that amount as a share investment, it has to be done through this route. So doing a one particular transaction as an advance and converting later on with the ECB or a share capital or an investment is not generally encouraged by the RBI. But your last sentence was subject to RBI. Yes, once the RBI gives an approval to you, then there's no issue. But without RBI approval, it cannot be done. For everything what you do, there is a methodology, there is a circular, there is a supporting document, there is a procedure, and it has to be done in that way only.
Venkateshan from Mumbai, I asked for the netting off in case of services. Whether netting off allowed in case of services?
Services to service is allowed. Services to goods cross, it is not allowed.
Oh. Aniket from Pune, what if goods were exported to Ukraine or Sri Lanka and now I can't bring back the goods or money?
Go for write-off. Or if the goods are physically available, divert it to any other country or bring it back. But if the goods are destroyed or not available, or it's a risky to go over there, then it's a bad luck and apply for the write-off.
Ankush Pava from New Delhi, how to reach out to you for giving assignment of write-off approval from RBI on behalf of my company?
Refer to Kuldeep ji.
So we done with all our questions from professionals. Though I don't think there are no more questions.
I think we are
From
closing at a
India.
dot 6.
Yeah, we completely use our time of 2 hours. Okay, sir. So on behalf of everyone present in the webinar, I want to thank you for sharing your expertise, view on the topic. We really appreciate the time you gave us from your busy schedule. Hoping to hear from you again and have a nice day, sir. Thank you very much for the great session.
It's my pleasure too. Thank you.